Hello everybody and welcome to our lesson 2-1. We're talking about the types of business ownership in this case. Now this particular lesson does have a lot to do with business law, so we're going to be discussing some legal terms in this, but let's go ahead and get started. So how a business is legally structured really is an important consideration when you are running a business, starting a business. Okay, it's one of the many decisions that you have to make when you are starting a business. So before we dive into the different types of business ownership, we need to discuss a term that is called liability, because this has a lot to do, a big part of how you're going to make your decisions regarding your business. So liability is the legal responsibility of an individual or an entity for the actions, debts, and obligations of the business. Some businesses have unlimited liability. That means that your liability goes beyond your individual financial investment in the company. We're going to talk more about that as we go along. Limited liability, though, is a liability that restricts the individual's potential loss to the amount of, based against the amount of their investment in the company. It's really important to understand the difference between limited, unlimited liability, because it is important and they will help guide ownership structuring decisions. Now, there are essentially 4 types of business ownership, and some of these have variations. So let's go ahead and get started. First off, let's define what a small business is. A small business has fewer than 500 employees, and most of those small businesses have even less than 20. And almost, well, shouldn't say almost, but many of those small businesses they're run by only one person, and this person is called a solopreneur. Okay, it's different than an entrepreneur, it's a solopreneur. But a solopreneur, they still need to have legal distinctions in order to file their taxes for tax filing purposes. So again, a sole proprietor is a business that is owned by one person, and that owner has unlimited liability. So the owner is personally responsible for all of the business's debts and obligations. Now, the advantages are with a solopreneur or a sole proprietor is that it is easy to get started. There's no registration required, and the owner is the boss. On the flip side, some disadvantages of being a sole proprietorship or a solopreneur is that you as the owner, you're responsible for the profits and loss of the company, and you run the day-to-day operations. And again, you are responsible for everything, for all of the associated liabilities when it comes to your company. Now, the second type of business ownership is called a partnership. So let's say you're this sole proprietor, you as a sole proprietor or a solopreneur, you find a partner or maybe 2 or 3 to help start and you run the business. So a partnership by definition is a business that is owned by 2 or more people. There are different types of partnerships, and the differences have to do with how the operational participants, our operational participation, the control, and the liability. So a general partnership is like a local bakery or a family business. A limited partnership is kind of like a private equity firm or a hedge fund. Limited liability partnerships, these are like a doctor's office or a law firm. So let's get into some more specific definitions of these. So a general partnership is where all the partners have the decision-making and the management power, and they also have unlimited liability. On the other hand, you've got a limited partnership. Now, these are businesses where you've got 1 or more partners that aren't actually active in the business. They have no decision-making power, and they are limited in their liability based on the amount that they invested, that they contributed to the business. Again, some examples of some general partnerships include like a local bakery, okay, or like a limited partnership is a private equity or a PE fund. Firms or hedge funds. Those are all go into finance stuff. We're not going to be talking about those in this lesson. But let's talk about the last one. This is a limited liability partnership or possibly an LLP. This is a hybrid business structure where all the partners have the decision making and the management power, but they have limited liability. They can't be held responsible for the other partner's actions. Okay, they're only responsible for their own actions. So if you are starting a partnership, if you're creating a business that is a partnership, you want to have a partnership agreement. This is a legal document that outlines the rights, the responsibilities, and the obligations of each individual in that partnership. Now, the next type of type 3, or the next type of a business operation, is what's called a limited liability company. These are also known as LLCs. Okay, this is, again, it's a hybrid business structure where it combines the operational characteristics of a sole proprietor and a partnership, and also limiting the liability of the investors, again, depending on what they have invested in the company itself. So when it comes to limited liabilities companies, or again, LLCs, okay, limited liability company, LLC, okay, here's some characteristics of an LLC. You've got common choice. This actually is a common choice for entrepreneurs if they've got one or more co-founders or partners. They have a tax pass-through. The tax liability is passed directly through each owner based on their level of ownership. So the individual owners of an LLC report their portion of the profits or the losses on their personal income taxes, just like they would with income from a job or from other sources. So again, you've got this limited liability. It's only limited to the amount that they invested. The other thing LLCs can do is they can raise money, but they raise it by selling something called units. We'll compare that with a corporation here in a minute. But they can raise money by selling units, not called shares, not portions of the company. And the owners are called members in this case. Now, speaking of corporations, corporations is the fourth type of business entity. So a corporation is a legal entity that is separate from its owners, and it is also controlled by a board of directors. The corporation has most of the same rights and the responsibilities that individuals possess, but they offer limited liability. Now, corporations, according to the law, are considered legal persons. They're capable of owning assets, incurring debt, entering contracts, and taking legal action. So it's just almost as if this corporation was a legal person. Okay, now when you are a corporation, in order to start your corporation, you have to file what's called an Articles of Incorporation, and it has to be done in the state where you operate. So an article of incorporation, this is a document filed with the government that legally establishes your corporation and is recognized under a state law. Now, there are different types of corporations, so we're going to talk about those different types of corporations. We're going to start with a public corporation. Now, this is a corporation that is governed by a board of directors. They sell shares of stock, they report financial information to the general public, but it is heavily regulated by the government. Some companies that you think of when you think of a public corporation, think of Amazon, think of Apple. Okay, and I know my handwriting's horrible. Okay, think of Macy's, the department store. These are all public corporations. Now, public corporations, they have shares that are traded openly on the New York Stock Exchange and or the Nasdaq. Now, a stock exchange is basically it's a clearinghouse. It's a place where for the buying and selling of stocks. Now, what is a stock? A stock is a type of security that represents ownership in a company, and it signifies a claim on part of that company's assets and earnings. You are essentially a part owner of this company if you have stock in that company. Now, speaking of securities, securities are financial instruments that hold some type of monetary value, and they can be traded in the financial markets. So a significant advantage of being this public corporation is the ability to sell stock and raise capital, because you sell the stock, you give somebody a part ownership in the company, they give you the money. Okay, capital is the same as money when it comes to businesses, when you're talking businesses. And access to that public capital can fuel faster growth and expansion, which can be sometimes difficult for privately held companies. Now, public corporations, they are, again, as I mentioned, they are heavily regulated by the government. They are required to report regularly and publicly on their operations, their finances, everything that they do. Now, this level of regulation and transparency could be why some corporations choose to remain privately held. So, speaking of privately held or private corporations, this is a corporation with a small group of owners that does not sell stock to the general public or report its financial information to the public. So private corporations, in this case, the shareholders aren't necessarily the general public. It could be the company's founders, it could be their families, their friends, or it could be private investors. And private corporations are not listed on the stock exchange, like the New York Stock Exchange or the Nasdaq, like public corporations are. Now, some examples of private corporations are Mars, the candy bar company, IKEA, the furniture company, and Lego, the toy company. All of these are private corporations. Now, continuing on with corporations, there are actually different types of corporations. And the type of corporation is determined by how they're taxed and what legal guidelines they have to file. So tax and legal guidelines. This is what determines the type of cooperation. So businesses can be incorporated as a C corporation, an S corporation, or they can be certified as a B corporation. So let's talk about each of these. So a C corporation or a C corp, they can sell unlimited shares of their stock to the public. They can sell as many as they want. 1,000 shares, 1,000,000 shares, whatever, how many, whatever. They sell it to the public. Public gives them the money. Again, C corps though are heavily regulated, and they are required to report their financial information to the public. Now, kind of a disadvantage of corporations is that there is what's called double taxation. Not only does the company pay taxes on its profits, but its owners also pay taxes on whatever profits, or in this case, if you're a shareholder, you can have dividends. That's your profit in the company. So this double taxation, the company has to pay and the owners have to pay. But you do have limited liability. So it all depends on the amount that you invest in the company. Next are S corp shareholders. Now, an S corp is a corporation that meets specific internal revenue code requirements. So each shareholder reports their portion of profits or losses on their personal tax returns. Okay, so the corporate taxes go through the shareholders for tax purposes. Now, in an S corp, you can only have 100 shareholders, which if there's only 100, that limits the amount of money that you can bring in by selling the shares. These shareholders also must be U.S. citizens or permanent residents of the United States. And they've got to be individuals. Companies cannot be shareholders of an S corporation. So you can't have a C corporation who holds shares in an S corporation. Now, a benefit corporation or a B Corp, this is a corporation that really considers the public benefit in its decisions rather than only being interested in maximizing shareholder value. So it's actually a type of certification for a business that achieves high social and environmental performance standards, accountability, and transparency. B corporations aim to create a greater balance between profit and purpose. So think Ben and Jerry's or Patagonia. These are both certified B corporations. So what type of business then are you going to form, or what type of business are you going to have? Well, you need to conduct a detailed analysis of the various business structures. Which one aligns with your individual circumstances, your goals, your resources, your risk tolerance, and so forth? Okay. Here's some questions to consider. Does unlimited liability seem too risky? Would heavy regulation, double taxation take up too much time, too much energy, too many resources? If there's changes in the tax law, could that affect your business somehow? Would that sway your decision? Or in another case, maybe you dream of going public. Now, going public actually is a very complex financial challenge that is usually reserved for larger companies or for smaller tech-oriented startups with a unique selling proposition, a proven track management, and a massive growth opportunity. So you got to be aware what type of business. You got to take into consideration all things like this to see when you analyze and decide what kind of business you're going to form. So really, when it comes down to it, remember, you want to choose the business structure that is going to best support your business goals. What do you want to do? Do you want to remain a small company? Okay, you might consider just an LLC or maybe an S Corp. Do you want to grow it into a bigger company? You might start out as an LLC and then move on to a C Corp. That's the interesting thing, is you can actually start as an LLC, and later on, if your company grows, you could change it into something like a C Corp. Okay, so those are things to consider. When you choose your business structure at the beginning, you can change it later on depending on how it grows. You just have to follow the right legal requirements to make those changes. So this has been our lesson 2-2. We talked about the types of business ownership. We discussed the different levels of liability. Remember, there's unlimited and limited liability. And we also talked about the 4 basic types of business ownership: the sole proprietor, the partnership, the LLC, and the corporation.